Hello, welcome back. This is Whitney Emmanuel here to talk to you about recession-resistant investing. This is video 2 of our series, and for this session, I will be talking about treasuries. So treasuries are government-issued securities that vary in term, also known as government securities. Treasury's bill maturity ranges from 4 weeks to 52 weeks, which is a year, and they are sold at a discount or at par. Par is face value. So when the bill matures, you are paid at its face value. So imagine $100 is the par value, but it's sold to you at $80. Over time, you're getting interest on that, right, over the year, let's say in this example. And then at par is $100 that you receive at the end. Treasury, so that's a treasury bill, a treasury note, or a treasury bond, all work that way. You buy it at a discount and then it matures at par. A treasury note's maturity ranges from 2 to 10 years. Notes pay a fixed rate of interest every 6 months until they mature. You can hold a note until it matures, or you can sell it before it matures. Treasury bonds maturity is either 20 or 30 years. Bonds pay a fixed rate of interest every 6 months until they mature. You can hold a bond until it matures or sell it before it matures. Treasury bonds are not the same thing as U.S. savings bonds. I've mentioned U.S. savings bonds in previous discussions, but that's not the focus for today. Just know that there's a difference between the two. So the rates vary throughout the term of a treasury bond. So one thing that you should know that you may have actually heard discussed with talking about, are we in a recession or not, is an inverted yield curve. Normally, you should get rewarded for waiting longer in a bond, right? So, and let's talk about this treasury note in the 10-year. You should get rewarded more for the 10-year than the 2-year. However, over the last couple of years, the 2-year note has actually been paying more, yielding more than the 10-year, and that is an indicator of a potential recession. So just a little sidebar. You can own these directly by purchasing directly from the Treasury website. You can buy these at a financial investment institution. You can buy these indirectly through a mutual fund or ETF. The first reason these are recession resistant is because they do not correlate with stock market fluctuations. Treasury fluctuations are based on interest rates, not stock prices. Secondly, they have leverage for their payback ability, their ability to tax, and that tax revenue that the federal government receives funds the payback to investors. Foreign countries all over the world purchase U.S. Treasuries because of the financial health of the United States and lower risk of default compared to other countries. Because we are in such a volatile interest rate environment, you want to be careful and avoid going too long with your term in a Treasury. The price of a bond and interest rates have an inverse relationship. So what that means, I talk to my clients about this a lot, is that when interest rates rise, the price of a bond decreases. The longer the duration of the bond, the more of a price decrease you will see in that bond. Short-term bonds are less subject to interest rate risk because of the shorter duration. This would not matter if you hold the Treasury bond to term. However, if you attempt to redeem your Treasury security earlier than the term, you may receive a lesser amount than you initially invested. Keeping in mind interest rate risk and your timeline, this could be a great recession-resistant solution. To determine whether this is a good solution for your situation, we would love to have a one-on-one conversation to discuss your needs and goals. Next video in this series, we will discuss bank-insured notes, so stay tuned.